Landlords who depended on substantial rent increases and persistently low interest rates are facing financial ruin as expenses are increasing and rents are flatlining. I'm Tony, and this is Real Estate Investing and Landlord News. All right, so I have an interesting article for you today, and it's going over the trouble that a lot of landlords are going to be facing in these upcoming years and who knows how long, as interest rates are now going to be persistently much higher than they were before. So back during the pandemic, they dropped the interest rates. They were super duper low. And a lot of people, they were investing with the idea in their head that interest rates were going to remain low indefinitely. Now, this was dumb, okay? Just looking at history, anyone could tell that, hey, with the way inflation is going and everything, the only response that the Fed, the Federal Reserve Bank, has is to raise interest rates, right? And that will be reflected to us in our loans with higher interest rates on our loans. So, I saw that this was coming. A lot of people, they didn't see it. They said, oh, well, they might raise it a little, but, they'll come back down. Well, for the long term, it looks like we're going to face higher interest rates than we saw for the last 15 years. And that's crazy. So, I mean, there's a lot of people out there who are investing and they've never seen higher interest rates, and they don't know what to do. They are really panicking, and it's put them in a very bad place. They bought their investments and they weren't profitable, thinking that, hey, we can raise these rents, we can depend on lower interest rates so that when we need to refinance, we can, and everything will work out. Well, it's not working out that way. And if they do go back to refinance, they're going to find that their properties aren't going to be valued as much as they had hoped they were valued for. And they won't be able to get a lower interest rate in many cases. So that means that they are stuck with properties that aren't going to be profitable. Okay. And this can mean that, hey, there can be a lot of foreclosures and bankruptcies coming in the real estate market. I don't know for sure. I think that it's coming. I think it's coming. Okay. I think that a lot of landlords, a lot of real estate investors are going to end up upside down in this coming economy. Okay. And, the rents are flatlining in a lot of major cities. So places like New York, the rents aren't going up as much as they had been before. And, there's only so much people can pay. There's only so much money that people can afford to pay for rent. With all the layoffs and everything that we've been seeing in places like San Francisco with all the tech companies, I mean, I don't doubt for 1 second that rents are declining there too, So this is a bad situation. I hope that there aren't too many landlords, but think of it in a different from a different position. There could be a lot of opportunity for those landlords out there who are in a decent financial position. So before I get into the article, go ahead, hit the like, subscribe button, maybe leave a comment down below and let me know what you think. I know that there are a lot of smaller mom and pop landlords who watch this, and this article I'm going to be covering is more talking about the big landlords, but I do know that there are some small mom and pop landlords out there who did invest in these properties. They bought these properties at the top of the market thinking that they would be able to raise rents and then refinance using the BRRRR method. The BRRRR method is very popular, using that BRRRR method, and now they're finding that, hey, the BRRRR method just doesn't work as good as it used to with these new higher interest rates and without property values continuing to increase. So they're in trouble. They're in trouble. So do you know any small landlords who might be struggling through this, or are you struggling through this time right now? And no offense against you if you are, because we all could be in that position at some point. So I just am curious what stories that you guys have to tell. So anyway, let's get into this article because it's quite interesting, and it does apply to big and small landlords. This article is coming from businessinsider.com, and it says, landlords pumped billions into apartment buildings during the pandemic. That bet could go horribly wrong. And it has a list of a few bullet points going over the main topics of the article. I'll read those first. Big money investors pumped billions into buying up apartment buildings in the pandemic era. The deals were often based on the assumption that rents would continue to increase. But rents are flatlining and expenses are increasing, leaving landlords facing big losses. Yeah, and not just the big ones. Like I said, this could hit the small landlords as well. If you bought a duplex thinking you'd be able to raise the rents, do a burr, and it didn't work out, well, you could be stuck with a property that you can't refinance. So if you bought, especially in the more expensive markets, a property that didn't cash flow, and then you thought you would be able to refinance it and get it to cash flow, well, you could be stuck. Okay. So anyway, let's get into this article and see what it says. While offices have been going through a paradigmatic shift as more workers do their jobs remotely, apartment buildings have experienced robust demand from tenants. But fault lines have emerged for investors who paid top dollar for assets that depended on substantial rent increases and persistent low interest rates to achieve profitability. Those kinds of optimistic projections became increasingly necessary in the booming markets of 2021 and 2022, when investors grew voracious for apartment building acquisitions, boosting competition and prices. In those years, investors purchased $355.5 billion dollars and $299.2 billion dollars worth of apartment buildings, according to MSCI, unprecedented sums that far surpassed the previous 194 billion dollars record of multifamily sales in 2019. Yeah, they had very, very cheap interest rates. There was a ton of stimulus money going through the market. There were a ton of people who were looking for a higher rate of return. They were looking at real estate as that. So there were a lot of investors who were investing in real estate, seeing it as a much higher rate of return than investing in bonds or whatever. So they jumped in. They were paying top dollar for this stuff, not realizing that the market could possibly fall in the very short term. Okay, and a lot of people were screaming. A lot of the people who know real estate investing were saying, "Hey, these numbers are outrageous. This is crazy. Maybe we should slow down. Maybe we should slow down our purchases." But not everybody was listening. Not everybody thought like that. I slowed down my purchasing. I had intended on, expanding much, much larger, but I did not because I saw that the prices, they were not, they weren't in touch with reality. If I can't cover the, PITI, which is the principal, interest, taxes, and insurance, if I can't cover the PITI with the monthly rent payment on a property, then I'm not buying it. Okay. I need to be able to cover the PITI and a little bit more than that so I can cover my additional expenses, such as property management, utilities, etc. And I couldn't even do that on a lot of properties because they had them priced so high that the only way that you would be able to get them to cash flow would be if you kicked the tenants out and instantly rose the rent up to some really, really high number. I mean, and that just doesn't work. That's not my strategy. Okay. So yeah, I always buy properties when I know that they at least cash flow a little bit. I want to be able to increase the cash flow more going into the future, but I don't buy properties that are negative cash flow from the get go because I am afraid of this sort of thing happening, and this is exactly what's happening on a large scale to these big apartment buyers. To win a deal in that hyper competitive market, investors needed to make ambitious predictions how they could grow rents and control expenses, said Will Matthews, a multifamily investment sales broker at Colliers. What they found is that rents have plateaued or have even come down in some markets, and expenses have skyrocketed. The problems could mushroom as more mortgages expire at properties where fix and flip strategies have stalled, throwing a growing number into default. Yeah, and that is a big problem. Okay, so the strategy being burr, even for large apartment buildings, or fix and flip, as they say here in this article, means that you have to do a refinance because you might have bought into the property at, with a loan that had a higher interest rate in order to get all those repairs done. And you're thinking, okay, well, I'll be able to flip it over into a longer term loan, and then I'll be okay with the higher rents that I'm able to get. But in some of those cases, you're not able to get much higher rents, or the rents that you're able to get don't actually cover all of the costs that you spent. So, yeah, there's a possibility that a lot of landlords could get caught up in a mess, and this is going to lead to foreclosures or bankruptcies of these companies, right? But like I said at the very beginning, this could be a great opportunity for those people who are well positioned. Now, if you have the money and you could come in and pick up these distressed properties for cheaper than what the people who lost them were selling them for, well, you could end up making a ton of money on your own. So yeah, there's always opportunities in this, but I feel bad for the investors who, they didn't know all this was coming. And the real estate market can be pretty risky sometimes. And at the very end, at the very top of the market, before they started raising interest rates, there were a lot of people jumping in who they didn't, they don't know much about real estate investing. They just saw all the money that was being made and they thought, oh, this is a perfect opportunity. There always are people like that. They always hop in at the top of the market and they're the ones who lose the worst. Okay. The people who have been investing for a long time, that they know that these kind of things happen, they are in the best position to survive and get through all of this. So I'm not saying that I'm that person yet, but I will say that, like I said earlier, that wasn't my strategy to be doing that sort of thing, and that I had to have cash flow from the very beginning. So even though I did buy properties last year, my properties are cash flowing as of right now. Okay, that's without depending on refinancing or any of that stuff. So yeah, everything is good with me, for now. But I like I said, I understand that this could happen to anyone, including me. Collateralized loan obligations look shaky. Some of the most speculative investment deals were done with mortgages shoveling into a riskier part of the securitized loan market known as commercial real estate collateralized loan obligations, or CRE CLOs. These loans generally stretched 2 or 3 years, had floating interest that rose sharply as the Federal Reserve hiked its benchmark rate, and featured higher leverage levels that covered a larger portion of an asset's purchase price. CRE CLO delinquency rates have been low, but observers expect an uptick. It's early, but it's going to become a bigger story, especially if interest rates stay high and lending standards are tight, said Alan Todd, the head of commercial mortgage backed security strategy at Bank of America Global Research. Right now, the water is in the pot, the heat is on, but we're waiting to see when it comes to a boil. There are signals of stress. A TREP analysis found that in Washington, D.C., for instance, 71.9% of multifamily properties financed with CRE CLOs didn't earn enough rent to cover their debts. TREP attributed some of the pain in that pool of troubled loans, which totals about $1 billion, to the remote work policies among federal government offices, the dominant tenant base in the city, which have allowed workers to migrate and work from afar, weakening the local rental market. Yeah, and I can speak from experience for this one because, as well as being a landlord, I also work as a federal law enforcement officer. I don't work in D.C., but I can tell you that they had implemented a ton of remote work policies within the federal government. And so people weren't actually going into work, and they were, that what that did was it encouraged a lot of people to move further out away from DC. Instead of having an apartment right there in the city, they were like, no, I can live 40 plus miles away because I don't have to, worry about this commute anymore. But, I personally, I don't have any problem with that. But what this really tells you is that the strategies that were being used before, they're just not going to work anymore. We have to adapt and change as times change. So what is the new strategy going forward? I'm not sure just yet. I'm trying to figure that out on my own. A lot of landlords still have to figure that out as well. And first we have to figure out, if we're going to be falling into these same problems as these big apartment landlords are or not.